Question 1. An individual who induces a policy owner to lapse, forfeit, or surrender an existing life insurance policy to purchase a new one with another insurer, to the detriment of the policy owner, is guilty of A. Rebating, B. Twisting, C. Churning, D. Misrepresentation. Answer: B. Twisting. Twisting refers to the illegal act of an agent or insurer convincing a policy owner to replace an existing life insurance policy with a new one to their disadvantage. This typically involves misrepresenting or unfairly comparing the terms of the policies, leading the policy owner to surrender a policy that is better suited for their needs. The core concept here is replacing a policy in a way that harms the policyholder, often for the agent's commission gain. Remember that twisting implies an unfair or misleading inducement to switch policies. Question 2. In North Carolina, what is the minimum grace period for a life insurance policy? A. 15 days. B. 20 days. C. 31 days. D. 60 days. Answer: C. 31 days. The grace period is a mandatory provision in life insurance policies that allows the policy owner additional time, beyond the premium due date, to pay an overdue premium without the policy lapsing. In North Carolina, the minimum grace period required by law for a life insurance policy is 31 days. This provision protects the policy owner from accidental lapse and ensures coverage remains in force during this period, even if a death claim occurs. Always advise policyholders to pay premiums promptly, but know this safety net exists. Question 3. All of the following are typically considered unfair trade practices in North Carolina except A. Defamation of an insurer, B. Misrepresentation in an insurance application, C. Offering a premium discount not specified in the policy, D. Charging different premiums based on different mortality factors. Answer: D. Charging different premiums based on different mortality factors. Charging different premiums based on different mortality factors, such as age, gender, or health status, is a standard and acceptable practice in insurance underwriting. This is how insurers assess risk and determine appropriate premiums. Conversely, defamation, misrepresentation, and rebating, offering a premium discount not specified in the policy, are all examples of prohibited unfair trade practices designed to protect consumers and maintain fair competition within the insurance market. Differentiation based on actuarial data is fundamental to insurance. Question 4. An applicant for a North Carolina life insurance license must be at least how old? A. 16 years old. B. 18 years old. C. 21 years old. D. 25 years old. Answer: B. 18 years old. To be eligible to apply for an insurance producer license in North Carolina, an individual must meet several requirements, including being at least 18 years of age. This age requirement ensures that individuals engaging in insurance transactions are considered adults capable of entering into legal contracts and understanding the responsibilities involved. It's a foundational requirement for anyone starting their career as a licensed insurance professional. Question 5. Which of the following statements regarding the incontestability clause in a North Carolina life insurance policy is true? A. It prohibits the insurer from contesting the policy for any reason after a specific period, usually 1 year. B. It prevents the insurer from denying a claim due to misstatements in the application after 2 years, except for fraud. C. It applies only if the insured dies during the contestable period. D. It allows the insurer to contest the policy indefinitely if fraud is proven. Answer: B. It prevents the insurer from denying a claim due to misstatements in the application after 2 years, except for fraud. The incontestability clause states that after a life insurance policy has been in force for a specific period, typically 2 years from the issue date, the insurer cannot deny a claim or void the policy due to misstatements or concealments in the application, even if they are material. However, this clause does not apply in cases of fraudulent misstatements where the applicant intended to deceive the insurer. It acts as a protection for the policy owner against future challenges to policy validity once a reasonable period has passed. Question 6. A life insurance policy's free look period in North Carolina allows the policy owner to A. Return the policy for a full refund within a specified number of days after delivery. B. Review the policy's cash value growth annually without cost. C. Make changes to the beneficiary designation without insurer approval. D. Receive a free policy illustration upon request. Answer: A. Return the policy for a full refund within a specified number of days after delivery. The free look period, also known as the right to examine period, is a mandatory provision in newly issued life insurance policies. In North Carolina, this period is 10 days, allowing the policy owner to return the policy after receiving it and receive a full refund of all premiums paid. This consumer protection gives the policyholder an opportunity to thoroughly review the policy terms and conditions and ensure it meets their needs before committing permanently. Always remind clients about this important right. Question 7. What is the primary purpose of the Medical Information Bureau, MIB, in life insurance underwriting? A. To share medical records directly with insurers to speed up claims processing. B. To provide a centralized source of medical diagnoses for all insurance applicants. C. To assist insurers in detecting and preventing fraud by providing coded health information. D. To determine an applicant's exact health rating and premium without further investigation. Answer: C. To assist insurers in detecting and preventing fraud by providing coded health information. The Medical Information Bureau, MIB, is a non-profit organization that maintains a database of coded health information about individuals who have applied for insurance. Its primary purpose is to help insurers detect and prevent fraud by comparing information provided on applications with data previously submitted by other member insurers. The MIB does not contain actual medical records or diagnoses, but rather coded alerts regarding reported health conditions, helping insurers flag discrepancies that warrant further investigation. Question 8. In North Carolina, what is the maximum number of days for an insurer to deliver a notice of information practices to an applicant, under the Privacy of Consumer Financial Information Regulations? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: B. 20 days. Under North Carolina regulations regarding the privacy of consumer financial information, an insurer must deliver a notice of information practices to an applicant no later than 20 working days after the date the policy is delivered or mailed. This notice informs the applicant about the insurer's practices concerning the collection, disclosure, and protection of their non-public personal information. This rule is designed to ensure transparency and consumer awareness about data handling. Question 9. Which of the following statements is true regarding policy loans in North Carolina? A. Only term life policies accumulate cash value and allow for policy loans. B. Policy loans are not taxable income to the policy owner. C. If an insured dies with an outstanding loan, the loan amount is added to the death benefit. D. Policy loans have no impact on the policy's cash value. Answer: B. Policy loans are not taxable income to the policy owner. Policy loans allow a policy owner to borrow money against the cash value of a permanent life insurance policy, such as whole life or universal life. These loans are generally not considered taxable income to the policy owner because they are borrowing their own money, or the insurer's money with the cash value as collateral, and not receiving a distribution. If the insured dies with an outstanding loan, the loan amount plus any accrued interest is deducted from the death benefit paid to the beneficiary. Question 10. A life insurance applicant in North Carolina must be given a buyer's guide and policy summary. A. Only upon request from the applicant. B. At the time of application, or no later than policy delivery if the application is not taken in person. C. within 30 days of policy issuance. D. Only if the policy has a cash value component. Answer: B. At the time of application, or no later than policy delivery if the application is not taken in person. In North Carolina, insurers are required to provide a buyer's guide and a policy summary to life insurance applicants. The buyer's guide provides generic information about various life insurance policies, helping consumers make informed decisions, while the policy summary provides specific information about the policy being considered. These documents must be given at the time of application, or no later than policy delivery if the application is not taken in person, ensuring the consumer has essential information before a policy is finalized. Question 11. Which life insurance rider provides for the waiver of premium if the insured becomes totally disabled? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Payer benefit rider. Answer: C. Waiver of premium rider. The waiver of premium rider is an optional addition to a life insurance policy that ensures the policy remains in force if the insured becomes totally and permanently disabled. If the insured meets the definition of total disability set forth in the policy, premiums are waived for the duration of the disability, protecting the policy's value and death benefit. This rider offers significant financial protection against the inability to pay premiums due to unforeseen health issues. Question 12. If a life insurance policy owner in North Carolina does not select a non-forfeiture option, what option will the insurer typically implement automatically? A. Extended term. B. Reduced paid up. C. Cash surrender. D. Accelerated benefits. Answer: A. Extended term. Non-forfeiture options are benefits available to a policy owner when they decide to stop paying premiums on a permanent life insurance policy that has accumulated cash value. If the policy owner fails to choose an option, the insurer will automatically implement the extended term option in North Carolina. This option uses the policy's cash value to purchase a fully paid-up term insurance policy for the same face amount as the original policy, for as long a period as the cash value will purchase. Question 13. Which of the following statements about variable life insurance policies in North Carolina is true? A. They guarantee a minimum cash value and death benefit. B. Policy owners bear the investment risk. C. They are regulated solely by the State Department of Insurance. D. Premiums are flexible and can be adjusted by the policy owner. Answer: B. Policy owners bear the investment risk. Variable life insurance policies are unique in that their cash value and death benefit can fluctuate based on the performance of underlying investment accounts chosen by the policy owner. Unlike traditional whole life policies, variable policies do not guarantee a minimum cash value or death benefit, meaning the policy owner assumes the investment risk. Due to their investment component, these policies are regulated by both the State Department of Insurance and the Securities and Exchange Commission, SEC. Question 14. In North Carolina, what is the maximum interest rate an insurer may charge on a life insurance policy loan? A. 6% fixed or 8% variable. B. 8% fixed or 10% variable. C. 10% fixed or 12% variable. D. There is no maximum specified by statute. Answer: A. 6% fixed or 8% variable. North Carolina law specifies the maximum interest rates that can be charged on life insurance policy loans. An insurer may charge either a fixed interest rate of not more than 6% or a variable interest rate of not more than 8% per annum. This regulation protects policy owners from excessive charges when borrowing against their policy's cash value. It's important to remember these limits as they dictate the cost of accessing policy funds. Question 15. A producer's license in North Carolina may be revoked or suspended for all of the following reasons except: A. Failing to notify the commissioner of a change of address. B. Conviction of a misdemeanor involving moral turpitude. C. Misrepresenting the terms of an insurance policy. D. Transacting insurance business with a non-admitted insurer through a licensed surplus lines broker. Answer: D. Transacting insurance business with a non-admitted insurer through a licensed surplus lines broker. Transacting insurance business with a non-admitted insurer, an insurer not licensed to do business in the state, is generally prohibited, but an exception exists when done through a licensed surplus lines broker. Surplus lines brokers are specifically licensed to place unique or high-risk coverages with non-admitted insurers when coverage cannot be obtained from admitted insurers. The other actions listed, failing to notify the commissioner of a change of address, conviction of a crime involving moral turpitude, and misrepresenting policy terms, are all grounds for disciplinary action, including license suspension or revocation. Question 16. The provision in a life insurance policy that states the policy will not pay out if the insured commits suicide within a specified period from the policy's issue date is known as the A. Incontestability clause. B. Exclusion clause. C. Suicide clause. D. Hazardous occupation exclusion. Answer: C. Suicide clause. The suicide clause is a standard provision found in most life insurance policies, stating that if the insured commits suicide within a specified period, typically 2 years from the policy's issue date, the insurer will not pay the death benefit. Instead, the insurer will usually refund the premiums paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide, and after this period, the death benefit would typically be paid even in the event of suicide. Question 17. Which of the following is considered an unfair marketing practice where an agent offers a prospective client something of value not specified in the policy in exchange for purchasing insurance? A. Defamation. B. Rebating. C. Twisting. D. Coercion. Answer: B. Rebating. Rebating is an illegal practice where an agent offers a prospect something of value not specified in the insurance contract, such as a portion of the commission, gifts, or special favors, as an inducement to purchase a policy. This practice is prohibited because it can lead to unfair discrimination among policyholders and undermine the financial integrity of the insurance system. The key here is the something of value offered outside the policy terms. Question 18. A life insurance policy's assignment provision allows the policy owner to A. Change the beneficiary designation without the insurer's consent. B. Transfer ownership rights of the policy to another party. C. Receive a portion of the death benefit before death. D. Increase the policy's face amount without new underwriting. Answer: B. Transfer ownership rights of the policy to another party. The assignment provision in a life insurance policy grants the policy owner the right to transfer all or some of their policy rights to another person or entity. This can be done as a collateral assignment, example to secure a loan, or an absolute assignment, transferring full ownership. For instance, a business might assign a policy on a key employee to a bank as collateral for a loan. This flexibility in ownership is a key feature of life insurance as an asset. Question 19. In North Carolina, how many hours of continuing education, CE, must a licensed life insurance producer complete every 2 years? A. 12 hours. B. 16 hours. C. 20 hours. D. 24 hours. Answer: D. 24 hours. To maintain an active insurance producer license in North Carolina, a licensee must complete 24 hours of continuing education, CE, every 2 years. Of these 24 hours, at least 3 hours must be dedicated to ethics-specific training. This requirement ensures that licensed professionals stay current with industry changes, regulations, and best practices, thereby maintaining a high standard of competence and consumer protection. Question 20. A beneficiary designation that reads, "To my children," per stirpes, means that A. All living children will share the death benefit equally, and no one else. B. If a child is deceased, their share will be equally divided among the surviving children. C. The deceased child's share will pass to their heirs, example grandchildren, rather than being split among surviving children. D. The death benefit will only be paid if all listed children are alive at the time of the insured's death. Answer: C. The deceased child's share will pass to their heirs, example grandchildren, rather than being split among surviving children. The term per stirpes, Latin for by branch or by roots, means that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will pass to their descendants, example their children or grandchildren, rather than being distributed among the surviving named beneficiaries. This ensures that a family line continues to receive its share of the inheritance. In contrast, per capita means by the head, where the death benefit is divided equally among the surviving named beneficiaries only. Question 21. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, along with a cash value component that grows based on current interest rates? A. Whole life. B. Term life. C. Universal life. D. Variable universal life. Answer: C. Universal life. Universal life insurance is a flexible premium, adjustable life insurance policy that separates the insurance protection, expense, and savings components. It allows the policy owner to vary the amount and timing of premium payments and adjust the death benefit. The cash value grows at an interest rate that may vary based on market conditions, unlike traditional whole life which has a guaranteed rate. This flexibility makes universal life popular for those seeking adaptable coverage. Question 22. In North Carolina, when replacing an existing life insurance policy, the replacing insurer must provide the applicant with A. Notice regarding replacement. B. Copy of the new policy within 5 days. C. Proof of insurability from the old policy. D. Written comparison of all available policies on the market. Answer: A. Notice regarding replacement. When a life insurance policy is being replaced, strict regulations are in place to protect the consumer. In North Carolina, the replacing insurer, the insurer issuing the new policy, must ensure that the applicant receives a notice regarding replacement at the time of the application for the new policy. This notice informs the applicant of their rights and provides essential information about the potential disadvantages of replacement, encouraging them to compare policies carefully before making a decision. Question 23. The accelerated benefits provision in a life insurance policy allows the policy owner to A. Increase the death benefit without additional underwriting. B. Borrow against the policy's cash value at a lower interest rate. C. Receive a portion of the death benefit while still living if diagnosed with a terminal illness. D. Convert a term policy into a whole life policy without evidence of insurability. Answer: C. Receive a portion of the death benefit while still living if diagnosed with a terminal illness. The accelerated benefits provision, also known as a living benefit rider, allows a policy owner to access a portion of their life insurance policy's death benefit while the insured is still alive. This is typically permitted if the insured is diagnosed with a terminal illness and has a limited life expectancy, or suffers from certain chronic or critical illnesses. This provision helps financially support the insured and their family during a difficult time, with the remaining death benefit paid to beneficiaries upon the insured's death. Question 24. Which type of policy protects an insured against the risk of outliving their retirement income? A. Whole life insurance. B. Term life insurance. C. Annuity. D. Universal life insurance. Answer: C. Annuity. An annuity is a financial contract sold by an insurance company that is designed to provide a steady stream of income payments, typically for retirement. Unlike life insurance, which protects against dying too soon, an annuity protects against the risk of outliving one's savings, often referred to as longevity risk. Individuals purchase annuities to accumulate funds on a tax-deferred basis and then convert those funds into a guaranteed income stream for a set period or for life. Question 25. A life insurance applicant makes a material misrepresentation on the application that is discovered during the contestable period. In North Carolina, what action may the insurer take? A. The insurer must pay the full death benefit regardless of the misrepresentation. B. The insurer may deny the claim and void the policy. C. The insurer may only adjust the death benefit based on the misrepresentation. D. The insurer may only refund the premiums paid. Answer: B. The insurer may deny the claim and void the policy. During the contestable period, typically the first 2 years of a policy, an insurer has the right to investigate statements made in the application. If a material misrepresentation, a false statement that would have affected the underwriting decision, is discovered, the insurer can deny a claim and void the policy, treating it as if it never existed. This protects the insurer from applicants who provide inaccurate information to obtain coverage they wouldn't otherwise qualify for or to get lower premiums.